Hi Fools, healthcare analyst David Williamson, and welcome to Market Checkup, the Motley Fool's healthcare-focused investing show. Let's get right to it. Our winners today, we have two. Our first winner is Seattle-based Emeritus. Shares are up over 35% after agreeing to be purchased by Brookdale Senior Living. The combined company will be in 46 states, so nearly all of them. And with over 1,100 facilities, we'll have about a 10% market share. Now, scale is going to become increasingly important to this industry, especially when dealing with reimbursement cuts from Medicare. Now, both of these companies regularly post losses, although their cash flow situation is stronger than a quick glance at their financials would suggest. I still think investors should wait and see if they are better together than apart before jumping in and investing in this new, larger combined company. Now, our second winner today is orphan drug maker Isis. Isis is at it again. It reported positive phase 2 results for a rare spinal disorder called spinal muscular atrophy, and shares are soaring 15%. It's probably a little early to be throwing around sales numbers for this drug, considering it's still in mid-stage trials, although that hasn't stopped some analysts from calling this a potential blockbuster product. To me, I see this as more as further validation for Isis's platform, and it will help power future development deals, which Isis is clearly very fond of getting. This drug is partnered with Biogen, but Isis is active with courting partnerships, including one for its only approved drug, Kynamro, which is partnered with Sanofi's Genzyme division. Given the early returns on its platform, the big pharma and biotech interest, and really the sheer amount of pipeline assets, Isis is more than just a one-trick pony and deserves watching despite its 250% run-up over the last year. This is a stock that, if its pipeline develops, could certainly continue to head higher. All right, so let's move on to the other side of our coin, our losers, and we really only have one big loser today, which is Express Scripts. Shares are down 4%, which is a big move for a $60 billion company. Clearly, Wall Street wasn't impressed with its fourth quarter results. Now, revenue just skated past estimates. Adjusted earnings were right in line at $1.12, exactly with what consensus had. Guidance for 2014 was pretty much in line as well with what the street was expecting, between $4.88 and $5. Wall Street was looking for the low 490s, so there's possibility of getting above that. But there were some concerning trends. We've now seen revenue decline both year over year, the last 2 quarters, and sequentially in 3 of the last 4. Earnings per share has improved largely thanks to buybacks that will continue in 2014, but organic script growth will be in decline this year. I'll be digging into the comments to see what Express Scripts has to say regarding the Affordable Care Act and how Obamacare is changing its relationships in a various number of ways, and if the company plans to keep growing through acquisitions. Now, M&A has been a real key part of Express Scripts' strategy. Obviously, they picked up Medco and grew to be a key player. And given its status as a key member of the pharmacy benefit manager oligopoly, it's really just at this point Express Scripts, CVS's Caremark unit, United Health's Optum Health, and Catamaran. It likely can't pick up too many more of these assets in its core business. So how is Express Scripts going to grow? What sort of ancillary business are they looking to pursue, or are they done with M&A and really they're going to focus on optimizing and growing organically? But again, some of the script numbers are a little concerning. So I'll be digging into their call a little later. Stay tuned to Market Checkup for more coverage of that. But again, Express Scripts does have a powerful market position in an oligopoly, and that's something investors are often fond of. So tough day today for that company, but it will probably bounce back. All right, so moving on to what we're watching. And what I'm watching are activist investors agitating biotechs. Now, we've really started to see an increase of this lately. Obviously, Carl Icahn had his huge success. He's been invested in Forest Labs for quite some time, and he finally got it sold off. Actavis came in, the big generic drug maker, bought it up at a pretty nice premium. Forest is now up about 125% over the last 6 months. So it's been successful for Icahn, and it's been successful for investors who were alongside him. This deal is going to change Actavis's business model. So we'll probably dive into the pros and cons of that deal specifically, but it was largely powered by Icon's agitation of the board, and we've seen other companies do this as well. Sarissa is a company that, along with First Manhattan, got some changes with obesity drug maker Vivus in the CEO suite and on the board. However, that hasn't worked out as well. Vivus is down about 45% over the last 6 months. So it remains to be seen if it's really going to be, and it likely will be, a case-by-case basis for these things, because Vivus obviously has competition from Arena. It will have more competition from Orexogen going forward. And now Sarissa is involved with Ariad Pharmaceuticals. Ariad obviously suffered a pretty bad fall when its key drug Iclusig was temporarily pulled from the market due to safety issues. It's back on there with a black box warning from the FDA, but it's going to be sort of stuck as a last line treatment, and it's going to be tough for Ariad, which is trying to expand it into different treatment areas, given its potential safety issues that will crop up regardless of essentially the indication it's treating. So it'll be interesting to see if Sarissa can do a good job and maybe find a company, a buyer for Iclusig despite its safety issues. It still is an effective last line treatment. So I think for Sarissa, Ariad is a more interesting move than potentially Vivus. But between the two, we'll be watching, and we'll be watching just to see if more hedge funds and activist investors get involved and try to shake up management in the biotech space, but it's definitely something to watch going forward. And thanks for watching Market Checkup. Stay tuned to Fool.com for all your healthcare news, and Fool on.